Welcome back to the channel. It's me, Adam, and you are watching Unlimited Options Investing. In this video, I'm going to be talking about 3 stocks that I am looking at for 2022 as some potential turnaround plays that I think could do very well. Additionally, I'm going to be looking at LEAPS options that expire in January 2023 that could potentially be good buys moving forward. These 3 stocks are all large cap companies, which I find the easiest to trade options on as they're a lot more predictable than the smaller cap companies. Don't get me wrong, they can also be volatile and they can also go in the wrong direction that you don't want them to go in. But at the same time, a couple of them are pretty beaten down, one of them not so much, but I'll give my opinions on that. So if this is your first time stumbling upon the channel, welcome aboard and hit that subscribe button. Here at Unlimited Options Investing, we talk everything from stocks, crypto, options, ETFs, and we're investing for the long term. As always, smash that like button and let's get started. All right, the first stock of the bunch, surprise, surprise, we have PayPal stock. And this one has been absolutely bloody over the last few months. If we look at the last 6 months, it is down 34.5% at a market cap of $225 billion. A multi-$100 billion company down 34%, a third from its valuation from only a few months ago. And often what I'm reading in the investment community is that people are really looking at PayPal as a turnaround play for 2022. And there was no reason for the fintech space to fall the way it has been over the last few months. So PayPal, Square, Visa, MasterCard all fell off from their all-time highs pretty considerably, for no apparent reason, just a lot of sentiment drying out from the sector. But in my opinion, it's going to come right back into it eventually. And this is a company that I'm willing to bet is going to be higher a year from now. If we take a look at the weekly chart ever since the crash back in March of 2020, so it fell below the 20 and the 50 on the weekly, grinding up higher against that 20 EMA until the beginning of September when it sliced through that 20. And then a few weeks later, even slicing through that 50 and then going lower and lower and lower. And then now potentially finding a new base around 180 to 190. With that 200 simple moving day average not that far behind at 153. And looking back at the summer of 2020, we consolidated at these levels that we currently are right now, between 170 to about 200 for quite a while. So it makes sense that we are finding some kind of base at these levels. We could continue falling lower. Just because it consolidated over here doesn't mean that it's for sure going to be rebounding from these prices, but it also gives us some kind of indication that we could be potentially turning around from here. So I'm going to switch this to the daily and then go to options. Let's choose a January 2023 strike price. And looking as an example at the $150 strike price, and just as of July of this year, we reached a high of $163 per LEAPS option, falling all the way down right now to about $55, bottoming out at about $48 per contract. So you think losing 33% on your shares is bad? Imagine losing 66% of your options call. So yes, options can be lucrative, but they can also destroy your portfolio if you aren't careful or you get some bad luck. And with a strike price of about 150, that gives you a delta of, let's say, 0.7, 0.8. And from my experiences, the more in the money, even though they're more expensive, end up being a lot better for your portfolio in terms of intrinsic and extrinsic value. Because the higher the strike price and the more at the money or out of the money the option is, the more risk you're taking. Yes, you are paying less premium, but you're also taking on more risk this year. And Disney is Disney. They don't need that much of an explanation. Like many other companies, they got hit hard by the pandemic. And we saw highs earlier this year just above $200 at 203. Now trading near the 52-week low of 142, just $10 higher. And we had reached that 52-week low earlier this month on the 1st of December. And ever since then, we've been holding support at around 145, 147, somewhere in that area. So when we take a look at the candlestick chart for this one is well below its 200 simple moving day average, as well as the 50 exponential moving average, and right now sitting right above the 20 EMA. And when I think Disney, I'm thinking long-term investment. I'm thinking of holding this company for the long term. So I have no idea if we're going to crack 140 and go to the next level, let's say at 135, 130, and even potentially even going lower than there. But at a certain point, the buyers are going to step right back up into the stock and push it higher. I think 2022 is going to be a very strong recovery year. From those non-work at home kind of companies, those recovery plays such as airlines, casinos, and Disney. Companies that have things to do in person such as Disney. So when we take a look at the options for this one, so we go to option, we'll choose expiration date of January 20th, 2023. And let's say a strike price of, right now we're at $150 per share. So let's say a strike price of $130. So again, which would give us a delta of about 0.7, give or take. And we can see when this one reached its highs back earlier this year when it was above $200. Each contract was going for 80.8. right now trading at about $33 per contract. Yes, the stock is down 13.66% over the last 6 months, but if you held an options contract since February, you would be down well above 50% on your call. All right, and the last stock I'm going to be talking about is JP Morgan Chase stock, JPM, with a market cap of $464 billion. This is my favorite bank stock in the US, and this one actually hasn't had a terrible 2021. It's up 25% on the year. You see that we've kind of rolled over the past few months, but I like JPM as a value play and as a way to diversify my portfolio, especially with interest rates about to increase this upcoming year. Banking companies are some of the biggest beneficiaries of higher interest rates. They make more money on the money they loan out. So taking a look at the candlesticks for JPM on the daily, we're below the 20, we're below the 50, and we're below the 200 simple moving day average. And scrolling back, we can see how much the 200 SMA has really caught up to the price action. Now, stocks don't necessarily need to bounce off their moving averages. They can do whatever they want. The price action can do whatever it wants in the market. But again, looking at it as a long-term play for 2022, if we take a look at the options, again, going to January 20th, 2023, and let's give this one a strike price of about 140. Again, trying to get a delta of 0.6, 0.7, 0.8, somewhere in that area. So again, this one isn't really off its all-time highs, where per contract it was $38. Right now, trading for $25 per contract. But let's say that JPM rallies back to all-time highs, which was about 172 per share, and goes up to 175, 180. Contract should be making new all-time highs as well above this $38 per contract. All right, and that is the end of my video. Thank you very much for watching. As always, let me know in the comments below, are you buying any LEAPS options in any of these 3 companies or any other ones? Or if you're buying shares in Disney, PayPal, or JPM, let me know in the comments below. As always, subscribe and like, and I'll see you in tomorrow's video.